Welcome back to Wealthy Business, the channel where we explore the world of finance, markets, and personal growth, helping you navigate the trends that shape global wealth. Today, we're tackling one of the most important questions in the financial world right now. Is artificial intelligence in a bubble? From NVIDIA's record-breaking valuations to AI startups reaching billion-dollar status overnight, the fear of missing out has taken hold of investors worldwide. But one of Wall Street's most respected voices, Howard Marks, says, not so fast. Let's unpack why Marks, a man who's built his career identifying market extremes, doesn't believe the AI boom is a bubble yet, what psychological patterns he's watching for, and what this means for investors like us. One, who is Howard Marks and why his view matters? Before diving in, let's remember who we're talking about. Howard Marks is the co-founder of Oaktree Capital Management, managing over $170 billion in assets, and author of some of the most influential memos in modern investing. When Marks speaks, markets listen. His insights on market cycles, investor behavior, and value investing have guided generations of professional investors, including Warren Buffett, who once said he always learns something from Marks' letters. So when he comments on artificial intelligence, arguably the most hyped sector in finance today, it's worth paying attention. Too high but not crazy. Marks' take on AI valuations. In a recent CNBC interview, Marks addressed the elephant in the room. Are AI valuations too high? His answer was nuanced. The valuations are high but not crazy. Expensive and going down tomorrow are not synonymous. In other words, just because something is expensive doesn't automatically make it a bubble. This is classic Marks, separating price from psychology and valuation from mania. Yes, AI stocks are priced richly. But unlike speculative frenzies of the past, there's still a rational belief underpinning the enthusiasm that AI has the potential to reshape industries, create productivity gains, and fuel economic growth for decades. 3. The defining trait of a bubble: psychological excess. Marks then zeroed in on the real hallmark of bubbles, not just high prices, but collective psychology gone wild. The main ingredient in bubbles is psychological excess, some kind of temporary mania. For a company in this sector, there's no such thing as a price too high, and I don't detect that level of mania at this time. That's a powerful distinction. We're not yet seeing the "this time it's different" mindset that fueled previous collapses. Investors aren't mortgaging homes to buy AI stocks. Companies aren't going public overnight with zero revenue and trillion-dollar dreams. Instead, the excitement around AI, while intense, remains grounded in the belief that this technology will deliver real economic value. 4 lessons from the dot-com bubble. Marks, of course, knows his history. He compared today's AI boom to the internet mania of the late 1990s, a period that changed the world, but also destroyed countless fortunes. Back in '99, people said the internet will change the world, and it certainly did, he said. But the vast majority of the companies that went public ended up worthless. The key insight? Even when a technology is revolutionary, most of its early participants fail. That's why Marks urges investors to distinguish between great themes and great investments. 5. Recognizing bubble psychology. Marks outlined the psychological signs that typically define a bubble. Investors assume current leaders will stay dominant forever. People believe even weak players will succeed just because they're in the right sector. Speculators chase tiny chances of massive returns, saying, a company with a 2% chance of going up 100x is still a winner. He called that logic a reach too far, the moment when reason gives way to fantasy. For now, Marks doesn't see those signs in the AI sector. 6. AI hype versus real value. Marks made an important point. AI enthusiasm isn't misplaced. People are counting on AI for a lot. And I think it's probably going to deliver a lot. We just have no idea what it's going to deliver, when, or in what form. That humility, acknowledging the limits of foresight, is what separates disciplined investors from speculators. The truth is, AI will transform industries, from healthcare to finance to manufacturing. But the timeline, winners, and scale remain uncertain. 7. The wealthy business takeaway. Here's the bottom line. Howard Marks doesn't see a bubble yet, but he's watching carefully. Yes, valuations are elevated. Yes, investor excitement is intense. But the manic psychology that defines a true speculative bubble, the blind euphoria, the can't-lose mentality, isn't here. Instead, we're witnessing a rational excitement about a transformative technology. So what can investors learn? Don't confuse high prices with bubbles. Avoid chasing trends blindly. Separate the technology's promise from the companies built around it. As Marx reminds us, the internet did change the world, but most .com stocks went to zero. The same could happen in AI. A few giants will thrive, many will vanish. For long-term investors, the opportunity lies not in predicting the next hype cycle, but in recognizing when optimism turns to mania, and staying disciplined when others lose their heads. That's timeless investing wisdom, and exactly what wealthy business is all about.